Today we will talk about why Warren Buffett cannot make the most profitable investment decisions, why not losing in investing is much more important than winning, and why a conservative approach can be the most profitable. My name is Kirill Juran. I lead the SMPL Consulting Group, where we support digital entrepreneurs in terms of taxes, law, or accounting. A very large portion of our clients are investors from whom I try to learn. I try to observe how they do it. Today's video is somewhat of a conclusion to my observations. One of the fundamental aspects addressed in investing is risk-reward. Essentially, I evaluate every investment from this kind of perspective. While the reward, some potential benefit from a given investment, is more in the realm of being somewhat obvious or more easily accessible. That risk aspect is something I see as often completely forgotten, and for me, in that ratio, the risk is fundamental. In fact, for me, risk control is much more fundamental than controlling the reward if I want to perform well in the long term. There are a lot of definitions that define what risk actually is. Some are such that they are different, like they seem nice, but they are actually bizarre. But in general, I think it is essential to realize that risk is some undesirable event, and that undesirable event has two qualities. There is some probability that it will happen, and there are consequences when it does happen. While this probability is something that people still somewhat perceive, the consequence of what happens is something that is often forgotten in risk. As a result, investors frequently suffer from various black swan events, as Taleb writes about. Essentially, these are situations where you have something that is very unlikely. This means that I am not even able to work with probabilities because something will just jump out at me by orders of magnitude, since those things may have never happened. So I am not able to properly estimate how likely they are, but they are real. However, their consequences are devastating and massive. Let me give you an example. If you play Russian roulette with 100 chambers, meaning you have 100 empty chambers and one of them contains a bullet, and you are playing for $1 billion. Even though the reward is enormous, $1 billion, the probability of a negative event occurring is extremely low, 1%, but the consequences are so massive that if you have all 5 in a row, you would never play this roulette. And the reason you won't play it is that it will eliminate you from the game for good. And that is exactly why I say that. Survival is the most fundamental aspect of investing. Buffett also claims that the key is to never lose capital, and I believe that understanding this thesis has many levels. I often get frustrated because I always tell myself that it's just a simple matter, and then I realize how non-trivial that thesis actually is, and it holds absolutely fundamentally. This means that if someone wants to perform well in the markets, the first essential condition is to survive. If I look at our clients, what they have in common, the successful ones, there are some things that can be found, but the main fundamental thing is that they survived, that they have not lost their capital so far. This is really important to realize because the fundamental assumption that you will be pulling some capital from the market in investments is that you have a ticket, which is your basic capital that you are working with, and if you lose it, you will lose your ticket to the game and you won't be able to play that game anymore. It doesn't matter how good of a player you are. It doesn't matter how unlikely the situation was that knocked you out of the game. If you have lost your ticket, then you are no longer playing. And it is precisely the observation of everything, investing through the lens of liquidation, that I have learned after various steep declines and similar experiences, or I try to learn, is actually to find out what can kick you out of the game. Let me give you an example. Why did I think that Buffett cannot make the most profitable investment decisions? Let's say that Buffett has $100 billion on his table. I don't know how much he has right now. And now, an investment lands on Buffett's table that has a 99% chance of doubling his capital in a week. An extremely profitable thing. In 1% of cases, he loses all of his invested capital, and in 99% of cases, he makes double. The expected value of this action is 98 billion. This means Buffett in a week on average, this investment earns 98 billion, increasing his portfolio by 98% on average. Can Buffett take all his assets and invest in this? Rather not, because if that 1%, that one unlikely percent, materializes, then he is out of the game and will never play again. He will also lose the basic return he could have on that 100 billion. He will lose 6 billion. I don't know, let's say that 6 billion a year at 6% would be something that he has as a super safe guarantee. So he will lose that too and will never play again. And this is, in my opinion, where I see that a small investor, especially one with a different cash flow, can make these decisions. And this is precisely related to the thesis that a more conservative strategy can be the more profitable one, because if I consider who made the most in crypto over the last year, it will typically be someone who was in meme coins. Someone might be inclined to say that the most profitable strategy is to be in meme coins. The problem with all these highly aggressive strategies is that the liquidation part is ignored, because if I have huge multiples and I keep spinning it around, and in 10% of cases it just takes me down to zero, then at that moment I can be profitable in 1 year, I can be profitable in 2 years, but if I stretch it out over a long enough period, I know that I will end up at zero. It's something like Russian roulette. If I play just a classic 1 in 6, if I play it once, I'm more likely to survive. But if I start making a living off Russian roulette, I can guarantee you that in the end, I'll end up with a bullet in my head. Taleb beautifully describes this in The Black Swan. He breaks it down well, and it is essential to realize that if you test risk with a catastrophic effect for long enough, which results in losing everything, you will ultimately lose everything, no matter how good and profitable decisions you have made. And here I would like to emphasize again why, for me, investing in yourself and in your own skills is so essential. It is something that will generate tickets to the game for you. If one invests in their business and simply increases their turnover and cash flow, it can also be a way to maximize how to enhance their return on investment. Because suddenly you can go a little more aggressive, but being aggressive doesn't mean you are making less profitable decisions. You can go more aggressive in terms of bankroll management because you know that somewhere that ticket will be created for you again. There can be different perspectives on this. This is at least mine. I think about it in a way that I take something that is extremely safe, which is some kind of business where I have a lot of control, and I actually see it as something that is the safe bet, those some kind of imaginary weights. And on the other hand, I can do some very aggressive things because I know that the left side, those safe assets, can buy back the ticket after some time. What is also essential to distinguish is investing and pulling money out of the market. Most of the narratives, because I understand where they come from, are that most investment narratives are about having a portfolio that I appreciate by 10% annually, and that is actually how I operate. And overall, I look at it in terms of how large the portfolio is, and it is simply relevant information. If someone operates in the market full-time, and we actually have such clients, then in certain areas, especially in those dealing with some market inefficiencies, typically these are sophisticated traders who have discovered something that allows them to print money. You can achieve absurd returns of 100% per year because you are not working as an investor, but you are working with the capital on a different level. You have the opportunity to close a trade identified as an arbitrage or inefficiency, making 1,000 euros, and keep turning that 1,000 euros over and over. So after a year, you will have a huge return, but you cannot do it indefinitely. That's it. In one video, I mentioned that we simply have clients who consistently make higher double-digit percentages annually, but the question is on what basis? Now, I've kind of digressed, but I actually think it's important to say, maybe I'll make a separate video about it. Some people are able to operate on having, I don't know, $300,000 and are capable of doubling it every year, but only from 300,000. Because the market is small, because the inefficiency is small, and they are simply unable to allocate more money there. So in some things, it is like that. And rather, if you didn't realize it, you won't be the person who does this. But in some things, it is such that the money is not relevant. Although that person acts similarly to an investor, the strategy is actually completely different. They simply go to exploit inefficiencies with a certain amount of capital they have. This is completely like a digression. Sometimes I will make a more sophisticated video about it, but I wanted to mention this because it has some relevance. Anyway, this is all I wanted to tell you. Thank you very much for your attention. If you have any of your own takes on this, feel free to drop them in the comments. I would love to read them. In any case, no matter what I said, think for yourself. No one can teach you that. Goodbye.